Well, hello and welcome to this week's update here on YouTube. So we have a new opening range. Why? Because the third Friday of the month just occurred. So write these numbers down. 3958. Anything above that, we're bullish. Anything below 3901, we're bearish. And we're sitting right at or just below the 200-day moving average. That's pretty significant as well. We're keeping a close eye on that. Now, we have moved down to this trend line, which I've mentioned to you guys quite a few times. This is a downward sloping channel line, or trend line, should I say, that's been in place since the beginning of 2022. So we broke that to the upside, and now we've moved back down to it. We did bounce off it slightly, and it'd be interesting to see what happens here. But we've got the new opening range. We've got our specific prices to know whether we're bullish or bearish. Now, we know that the Federal Reserve has raised rates, and if you look at this older article back in March 2022, they're talking about raising rates for the first time since 2018, right, from 0.25 to 0.5. So, to raise rates not that long ago from 0.25 to where it is right now, 4.75, is a pretty dramatic increase in a pretty short period of time, right? And what happens is when you raise rates that quickly, you break the system and you will start to see cracks in the system. Where have we seen cracks in the system? Obviously, the banking system. We've seen Signature Bank collapsing. In fact, three of them: Silicon Valley Bank, Silvergate Bank, and Signature Bank, all collapsing. Now, Silicon Valley Bank is a 40-year-old bank. It's been around for 4 decades, based in California. It's around has around $209 billion in assets, and it's the 16th largest bank in the United States. So what caused these collapses, Sean, and why is this a issue and something we need to keep more of an eye on? Well, if you look at TLT just as an example, right? They're looking at bonds. You can see here, right? 20-year Treasury bonds, okay? Now, you can see they've had a pretty big move down just in the last 12 months. Now, the banks in 2020 and 2021 saw a lot of deposits, right? Record amount of savings. There was a lot of stimulus checks being given out, a lot of free money floating around, and people were sitting on a lot of cash. And what the banks did is they used people's deposits to go and buy government bonds, right? Let's turn some of this cash. We don't want to hold too much cash. We want some cash and put it into real assets. Let's go and buy something that's really safe, like a government bond. Then what happened? The bonds fell dramatically, right? They had a huge fall. And this is all a result of the Fed raising rates too quickly to try and do what? Combat inflation, destroy demand. Now, we saw that the number last week, the CPI number, and that's what it is, a CPI. It's inaccurate, it's manipulated, but it's came down from 6.4 to 6%. Now, it's still 6%, even after all these dramatic increases in the interest rates and quantitative tightening for the first time. And, you can see here that they have reduced the Fed's balance sheet, but then what have we seen just recently? A huge move to the upside here, trying to shore up the banking system, right? So that was definitely something that shows that maybe they are starting to change their tune a little bit. So we had the CPI come out, but this week we've got the Federal Reserve coming out, right? So, and talking about raising rates, right? They have their press conference, the whole thing, and the consensus is now, with these three banks collapsing and a lot of pressure on the banking system, that they're going to raise rates by 0.25% rather than 0.5. It's probably on the cards, but it's not just that. It's what they're going to say. What's their forward forecast moving forward? They'll be dissecting that carefully. But going back to what the banks did, what caused this problem is they were investing a lot of people's deposits in these government bonds. And when they fell dramatically in price, this is what caused the banks to be sitting on a huge amount of unrealized losses. Then what happened is people started taking their money out of the bank. Why? Because putting your money in the bank, you're getting, say, 0.5% interest, right? Not a lot of interest. What you can do is take your money out and put it into CDs, certificates of deposit. So you can put your money in certificates of deposit and you shop around. They're not all the same rates. You can shop around and get good deals, maybe 4.5%, 5%. A lot better than 0.5. So, now you got to lock your money away for a year or 2 years or 5 years or whatever it is, but certainly a much higher return. Okay, so people were starting to take their money out and put it into CDs. This caused a big problem here for Silicon Valley Bank insofar as they were having to go from an unrealized loss in bonds to a realized loss. Okay, and this was a really big problem. You think about this: if you're sitting on a gigantic amount of risk with depositors' money and you buy $120 billion worth of bonds with a 5.6 year duration, means that for every 10 basis point move higher in the 5-year rate, the bank lost $700 million. 200 basis points, that's $14 billion of economic loss. Basically, the entire bank's capital is wiped out. Now, the US banking system right now is sitting on unrealized losses because of these huge move down in bonds of around $620 billion. So, there could be other banks that could collapse. And this is a real issue here. We know Silicon Valley Bank collapsed, but there's other ones here that are certainly weak as well. So we've got to be keeping a close eye on that. Now, obviously, the government did shore up the deposits from the Silicon Valley Bank, making sure that everyone who had money in the bank got their money back. They can't do that for everyone, though, and this is certainly something we need to be mindful of, because people now are going, well, if the federal government's not going to insure my deposits, in other words, I get my deposits back if the bank collapses, I'm going to take it out of that bank and put it into a bank like JP Morgan, where they will secure or insure my deposits, make sure I get my money. So that's another issue as well, another issue that could be happening. And this is obviously driving a huge amount of interest in Bitcoin. We've seen Bitcoin sitting at almost 27,500 US a coin from around 19, 20,000 in a week. Big move up. Why? Because people are concerned about the banking system right now, and rightfully so. There's 1 million new Bitcoin addresses generated this weekend. So huge flight to safety there. Can't do a flight to safety with bonds, or certainly you couldn't, because they've had such a big move down. But when you're getting this, and then you're getting Moody's actually cutting the outlook for the US banking system as a whole, that's a really big problem, right? Citing rapidly deteriorating operating environment. Big problem. Remember, US banks are sitting on unrealized losses of $620 billion thanks to bonds falling. Bitcoin holders tend to be long-term holders as well. So, that's where a lot of people are putting their money right now. Certainly in the last week they have been. So this week is probably a good week to sit on the sidelines with the Federal Reserve coming out talking about raising rates, how much they're going to raise rates, what they see going forward with their press conference, all of that stuff. Sitting on the sidelines is not a bad idea. Now, last week I spoke to you guys about GDX, right? I said to you, look, we've got a beautiful double bottom here. I also said gold has already moved up, and another big move, right? Gold's already moved. What will happen next is you'll see the miners move, right? So we saw this beautiful double bottom here, and we bounced off that and we moved higher, right, to my target of $30 here, just over $30, $30.80. So that's exactly where we went. Now, I spoke to you guys about buying the in-the-money 22 strike call. We bought that for $547 a contract. It's now worth $868. We also did a call spread, which made a 55% return in a week. So it's sitting on a 59% return in a week. Now, what you could do when you've got a situation like this where there's a lot of uncertainty, you've got a Federal Reserve announcement on Thursday, you don't know what they're going to say, more importantly, how the market's going to react to it. When you've got a profitable trade like I got my members into last week with this call option on GDX, which I called here on YouTube as well, you don't want to stare at this like a deer in the headlights. You want to do something. What do you have to do? Lock in profit. If you want to be a consistently profitable trader, you need to lock in profit when the market makes it available to you. Okay, so for me right now, sitting on a 59% return in a week, and the Federal Reserve speaking on Thursday, I'd like to lock in profit, right? So what you can do is you can close out the 22 call for the 21st of April, then simultaneously, at the same time, I want you to buy the 30 strike call for the same expiry. Now, if you had one contract, you keep one contract. 21st of April, same expiry, 21st of April. So you use the same expiry, same amount of contracts, but you're selling the 22, buying the 30. Why? Because you think it's going to continue to move up and you want to lock in the profits. Now, the 30 strike call is trading at around $180, something like that. Let's have a look. GTX. Okay, so if you look at this and we're going out to the 21st. Looks like they're refreshing. Haven't got the... Oh, there we go. Right. So the 30 right now is at $1.83. Right, $1.83. Right. So what does that mean? That means we've made $321 already. Right, per share we're controlling. One option controls 100 shares. You've got to times it by 100 for every contract. So we've made $321. And if we spend 185 of that to go ahead and buy the 30 strike call, what that does is enable us to stay in the position if GDX and gold miners keep going up and make more money. But what it also does is lock away profit, right? So 321 minus the 185 we're spending on the 30 strike call leaves us with $136, okay, per contract. Now, I've got 10, so it's $1,360 in the bank, yours to keep. No one can take it from you. It's money in the bank, a riskless, profitable trade where you can still make more money if the stock continues to go up. Happy days, right? This is the power of options, understanding how to lock in profit, lock it in, and stay in the trade, right? If you still believe the trade is valid, everything, all the edges for getting into it are still there, this is a very smart way of doing it. Okay, locking in profit, putting away the $136 a contract, that's in the bank. No one can take it from you. That's done. So you've paid your money back, you've paid yourself back, okay, plus you've locked in $136, plus you've still got the 30 strike call. Win, 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 right? So that's a good way of doing it as well. Or just close it out for a 59% return in a week. That's a pretty smart move also. So that's definitely what I'm looking at there. Now, as far as what's going on, the S&P 500, like I said, we've got a new opening range sitting at the 200. It's moved down to this downward sloping trend line, which has been in place since the beginning of 2022. We bounced off that. We'll be keeping a close eye on that. If it breaks that, we are going down, right? We are going down to probably 3,500 on the S&P 500 fairly quickly, right? So we'll keep a close eye on that. And, you know, if you look then at the NASDAQ, that's got a different picture here, right? That's above, in fact, I'll just show it to you here. That's above the 200, the 100, the 50, the 21 EMAs. So that's looking a lot stronger. And if you look at XLK, the largest sector in the market, that's a bit of a bull flag happening here. Consolidation pattern, that could break higher. And, you know, one of the stocks I'm looking at, not getting into right now because of the Federal Reserve, is Google, right? Beautiful double bottom, right up against the 200. If it breaks that and the NASDAQ moves up like I'm anticipating, we could do well. But again, the Federal Reserve could change all of that depending on what happens. So that's definitely something that I'm looking at. But then when you look at SPX, Sean, why is that not looking that bullish right now? In fact, it's probably looking more bearish than anything else. Well, a huge amount of what's made up of S&P 500 is energy, right? So energy stocks, look at that, well below the 200. So they're weighing down the S&P 500 right now, whereas NASDAQ looks a lot stronger. So I'll be focusing my ideas on the NASDAQ, Google being one of them. Semiconductors look okay as well. Again, these are just ideas for now, nothing getting into anything right now. Nice consolidation pattern, that could break higher. That's above all the key moving averages. And, you know, something like AMD, which is semiconductor, has already started to have that move, okay? Here's another semiconductor that's already had a very nice move. So there is some strength there, and there's some ideas that I'm looking at, but got to be patient, right? So I hope you enjoyed that. I hope you found something useful in that. And, you know, some people trying to understand what's going on here with the whole banking disaster. You know, it is a little bit complicated, right? And, you know, when you're getting bonds moving down like this, you got to understand it moves inversely to the yield, right? So there's an inverse relationship between interest rates and bonds. Okay, so interest rates go up, bonds go down. And why is that? Well, bonds are competing against each other on the interest income that they provide to make them attractive to investors, right? So when interest rates go up, the newer bonds have a higher interest rate. Now you got to remember, these bonds that were issued back here, were purchased back here, sold back here, they had a fixed interest rate based on what the interest rates were at that time. Now we know interest rates have gone from almost 0 to almost 5% in a pretty short period of time. That means that newer bonds have a higher return, a higher interest rate. So the existing fixed rate bonds have to sell at a discount to compete, which is why it falls, right? So we're not out of the danger zone yet. Federal Reserve trying to keep everyone calm, government trying to keep everyone calm. We don't want contagion to spread throughout the banking system, that's for sure, and getting huge bank runs going on. But we will see. We will see what happens. So this week, sitting on the sidelines, yes, I've got some ideas ready. Yes, we made great money with gold miners. And we can stay in the position with no risk. I like that as well. But this week is good to sit on the sidelines, right? So we'll see what happens this week with making sure there's no further bank collapses, see what the Federal Reserve is going to do, and we'll take it from there next week. All right, my friends, thanks so much for listening. All the best. Bye for now.